If you take a look and you turn back to the topic of who's going to lead the Fed and what it could mean for your portfolio, that's what our next guest is here to tell you about. His trading advice depending on who the president picks as the next Federal Reserve chair. Joining us now is Jan Szilagyi, the CEO and co-founder of Reflexivity, a markets AI-driven platform. And Jan, if we talk about the two Kevins, Kevin Warsh, Kevin Hassett, are there different playbooks that you have for either one of them? Maybe let's start with what happens if, hypothetically, Kevin Hassett is the pick for the next Fed chair.
Yeah, perfect. Hi, good to see you again. So the idea here is, and we've heavily leaned on our platform to kind of go through the odds, calculate the odds, and then come out with the best positioning advice. Under Kevin Hassett, the best position probably is the play on economic growth, which is usually the small caps. So if you get immediate rate relief, which for small caps means 60% floating rate debt versus 30% for large caps, and higher expected growth, that is usually the sector that should outperform. And the recent momentum that we're seeing in that is already suggesting that markets clearly are positioning for that possibility.
All right, but we also found out that the president himself says that Kevin Warsh, a former Fed governor, is also very much in the mix and near the top of that list as well. So what is the playbook for a hypothetical Kevin Warsh Fed chairmanship?
Yeah, so actually, interestingly, Reflexivity, based on a number of different sources that estimate the probability of that, actually puts Kevin Warsh now in the front runner seat. And so under that scenario, you would actually prefer financial sector stocks, so financial sector ETF, XLF. And the reason being that he is a steady pair of hands. He had been at the Fed before, obviously knows very well what he is doing, and is also seen as having a degree of market trust already, and probably a degree of moderation in terms of where this would go. And so the goal here would be to see the curve steepen and therefore the banks reprice.
All right. And then there's a hypothetical other scenario amongst others, right, that says maybe either of them could get it, but you don't know which one you can go with because the odds are maybe tilting one way or the other. Is there a playbook to be had there if you are unsure of what's going to happen?
Yeah, so if you really can't decide, or if you're unwilling to basically place the bet on either side, because from time to time really does seem like a coin toss, then the Vanguard Dividend Appreciation ETF, VIG, is probably the one for you, because under an environment of lower rates, which is really both scenarios, companies that are able to continue to maintain dividends are usually those that have pricing power. They obviously should do well because of the higher yields in an environment where yields are overall coming down. And there's also quite a lot of diversification in that sector. So it includes financials, healthcare, tech, consumer staples, and so on. So it's a lower volatility, obviously lower expected reward. But you would probably do well, and you should do well under both scenarios.